Stock Ideas then. We have Rahul Arora, CEO of Nirmal Bang Institutional Equities with us. Rahul, hi, good morning. Happy New Year to you and your team. 2015 was all about individual stocks. So let's talk about some stocks. What's your biggest bet for 2016?
Happy New Year to you and your team as well, Anuj. I think there are probably two that I would highlight from our entire coverage universe. I think this will probably be a year where you'll see urban discretionary come back in a big way. So Jubilant FoodWorks did have a very good year last year and then a very substantial correction. So I think that's one stock to bet on. And of course, that's a much higher market cap. And I think from the mid and small cap space, I think TD Power Systems will probably be the stock of the year, I think, from that genre. And I think from the large caps, I think ACC will probably be our top bet. So on various market cap chains, that's probably where we'll be.
Okay. Rahul, Happy New Year. Hope you had a good night as well. But wanted to ask you why? Why are the three stocks? What is the rationale behind why they should give returns in 2016?
So I'll start with the mid caps and then we'll work our way up because that's been the relative area of outperformance for the market. I think TD Power Systems Ekta has sort of wound down its entire EPC business. I think there's just about 5 or 6 crores worth of losses that they have to book, which we're expecting them to book in this quarter, where the results will come out in the next 1 month or so. This is a company that has reported losses at a consolidated level. At a 2.5% dividend yield and 70 crores of free cash flows over the next 2 years, and with nearly about 40% of its balance sheet being cash, you're getting the stock at about 12 or 13 PE. Ex cash, you're probably getting it at 10 PE. Yes, this stock has seen the highs of 450 and the lows of 280, but I think the fact that the EPC business has wound down and the fact that the Bihar locomotive factory is one engine of growth that will give some visibility of orders. So that's 1,000 locomotive engines, and GE will outsource all those 1,000 generators to TD Power Systems. So that's a 100 crore annuity order for 10 years, which will start, I think, from a year from now. But even X that, I think the US replacement market opens up for TD Power Systems. So I think it's a growth stock, it's a value stock, it's got cash on the books, and it's coming to you at reasonable valuations. Now, Jubilant FoodWorks, I think, unfortunately has suffered because the same store growth rates have not lived up to what the market expectations traditionally have been. But I think one thing I would want your viewers to understand is that same-store sales growth need to be in double-digit when inflation is at 7-8%. When you have inflation at 4-5-6%, even a 7-8% same-store growth is not bad. It will give you the delta on margins and on EPS growth. So our estimation is that this current financial year, Jubilant FoodWorks will report margins of about 12%, and that will probably go up to about 17% over the next 2 years. That's a 500 basis point improvement in EBITDA margins. EPS reported last year was 17 rupees. We're expecting that to go to 51. So that's a tripling of EPS in 3 years. And very, very strong return ratio profiles in the 30s for both ROE as well as ROC. So you're getting the stock at about 27, 28 times FY18 earnings, so that's another one. And ACC, the one concern has been it's not had volume growth in the past. It's got a 2.5 million ton clinker and grinding capacity coming on board. 100 million, it comes to you at about $100 EV per ton, if I'm not mistaken. That's one of the cheapest in the large cap space. I mean, Ultratech goes at about 150, if I'm not mistaken. So with capacity coming on board for ACC, reporting about a 7% volume growth for the next 2 years and coming to you at reasonable valuations, I think these could be 3 areas in the large cap, semi-large cap and small cap space to be.
Okay, Rahul, let's talk about some more stocks. Atul Auto, I don't think we've discussed this in the past. Is this your new recommendation, or what's the price target on this one?
Right. So Anuj, we initiated on this, I think, just a day or two back. We have about, I think, a 25% upside on the stock. It is into three-wheelers, essentially, which is dominated by Bajaj Auto. Piaggio comes in next, and then you've got Atul Auto. Atul Auto has actually improved its market share by about 500 basis points in the last 3 or 4 years, if you see. At a blended basis, they enjoy an 8% market share in the three-wheeler industry. That is as high as 20% in three-wheeler cargo and as low as 5% in three-wheeler passenger. The game here, Anuj, is that, one, it's important to know that it's a debt-free company. Again, 35% ROE, ROCs and a 2.5% dividend yield. So there's no concern on the financial metrics at all. They've launched a 0.35-ton petrol variant in November 2015, and now they're going to export this. So the export market opens up. It's almost 93% of the addressable market outside India and 34% in India. So that's going to drive, according to us, a 5x increase in volumes in exports between now and FY18. So the next 3 years, the volumes of exports, of course, part of it is base effect. And like I said, the financial profile is very, very strong. They're chipping away at market share from Piaggio. The fact that the market share has gone up by 5% from 3 to 8% over the last 4 years, they're chipping away at market share. So this is not going to be a 20% blended market share play in the next 3-4 years, but it will get into the double digits. We're expecting a 390 basis points improvement in margins over the next 2 years. led by a 17-18% top line growth and about a 25% growth in EBITDA and PAT. So I think if you're holding onto the stock, it's a very clean company, very good, very strong financial metrics, and a growth stock again, which you're getting at about 16.5 times FY18 numbers.
Okay. Well, SKS was a complete surprise story in 2015. Despite not getting that small bank license, they managed to recover a lot in terms of lost ground for them in terms of the price. Your sense, you have quite a steep target price, I think, of around 650 rupees. When do you expect it to be achieved by, and do you think that it could scale even beyond 650 at some point?
I'll tell you a very funny story on this, Ekta. When we initiated on this company, people told us that the biggest risk to SKS is getting the banking license. We were in a state of shock when we saw the stock fall 15-20% the day they didn't get the banking license, because it was almost a heads I win, tails you lose kind of story, because then people came back and said, oh my God, something is so wrong with SKS Microfinance. They didn't get it and a lot of other people did. I think what you need to understand is that there is a huge hangover of equity dilution in SKS Microfinance that goes away. For the guys that have got the banking license, the challenge begins now. Their cost of capex is going to go up. It's not going to be easy for them to manage. I'm not saying SKS Microfinance will not get a banking license. You see, they've not had a stable promoter for a very, very long time, Ekta. And then they had the Andhra Pradesh crisis. So you've never had a 2-3 year clean run on SKS Microfinance where you said everything is okay with this company. We're expecting a 45% AUM growth in SKS Microfinance over the next 2 years. This is a 4.5-5% ROA company, almost a 20% ROE company. I mean, if you look at the financial metrics, it's probably second to HDFC in the entire NBFC sort of space. It's right up there in terms of financial metrics. So then you will ask the question as to what valuations can this trade at. If you look at the current price at about 450, 500, I think somewhere around there at about 500, it's going at about 2.5, 2.7 times price to adjusted book. Almost no NPS on its book, and my analyst has assumed 150% increase in provisioning over the next 2 years, and yet we're getting a 42% PAT CAGR. So I think I would still buy the stock. You're right, our price target is 650. We're happy it's done well after the correction, but even at this price, I would advise investors in the non-banking space, this is definitely a stock to look at.
Okay, Capital First, I think, is the other stock that we haven't discussed in the past.
So again, Anuj, I think these would be our top 2 recommendations in the non-banking space. I think if you look at Capital First, their net interest margins were about 4.5% in FY14. They've taken it up to about 6.5% in the first half of this financial year. We expect that to be stable. The retail part of the book, which used to be 10% in FY10, has gone up to about 85%. We're expecting that part of the book to continue to grow at about 25% compounded for the next 3 years. A bulk of that growth is going to come in from the durable side as well as from the two-wheeler side, which we're expecting to compound by about 50% over the next 2 years. The MSME side, as we've been discussing, even in the case of microfinance, we believe is hugely underpenetrated in terms of loans. The addressable market, according to us, is 9.9 trillion rupees, but only about 5.5 trillion of that is getting serviced right now. 1.8 times price to adjusted book for a company that's going to compound 25% and has given you the kind of, and again, the NPAs at the gross level are just about 0.8% and at the net level about 0.4. You know, we're all aware of the promoter, Mr. Vedyanathan is a very high pedigreed person. He was in the race for ICICI Bank's top spot once upon a time. So there was no concerns on the pedigree of the promoter, and it's done well in terms of managing asset quality while being able to grow its book over the last few years. So I think our target price from here is about a 25-30% upside, if I'm not mistaken, valued on FY18 numbers. But this is a good franchise to be looking into. No concerns on asset quality, and like I said, you're getting the stock at fairly reasonable valuations.
And what's the story with Lakshmi Machine Works, right?
Yeah, so obviously,
price then?
Honestly, off the cuff, I don't remember my target price, but I think it has nothing to do with the news that came predominantly a couple of days back.
4,725. That's your target.
Thank you. Thanks for that. So obviously, what came in a couple of days back will only help in the longer term. But we're expecting the cotton yarn industry to grow by about 3 to 4%. This is a cycle play, right? So you get one cycle will last you about 4 to 5 years. So we're expecting the growth in cotton yarn to be about 4 to 5% over the next 5 years, which would mean that it would require an extra 7 to 8 million spindles. Lakshmi Machine Works enjoys a 70% domestic market share. 2,500 crores plus domestic order book, coming to you at about 15-16 times. Since 1996, barring 1 year, this company has reported operating cash flow positive every year since 96, and about 13 of those years have even been free cash flow positive. So we expect them to be cash flow positive for the remaining 2 years as well. But this is also a company, one of the few, that has set up shop in China, and within the first 3 years has actually turned profitable there. So they know what they're doing. They're a market leader. It's a virtual monopoly, is Lakshmi Machine Works. And what was announced yesterday or day before yesterday by way of the Textile Upgradation Fund will only help in taking their case forward with a 70% domestic market share.
All right, Rahul, thanks a lot for those trading ideas, or those investment ideas rather, let's put it that way. So that's some investment ideas for you for 2016. Let's take a break on that note.